Hey everyone, and welcome back to the channel. Today's video is going to be a little bit different than the typical video. This is going to be more of a follow-up of the video that came out last Thursday where I basically showed you an example of where I waited almost 2 years to invest in a company, waited for the price to become appropriate, and that took about 18 months before that happened. But waiting that time was the difference between having a negative 30% return, which is what would have happened if I originally had bought it 2 years ago, compared to the 200% return I've made on that stock just in this year by waiting. So this is a follow-up to that video. I highly recommend you check that video out before you watch this one if you haven't already. But for those who have, in today's video, I want to show you more of my thought process and my strategy behind waiting that 2-year period. I want to show you the maths behind what was driving my decisions, because of course, without a strategy to tell me when I should be waiting and when I should be investing, there's actually no way that I could replicate what I did with this investment over many years. There are a lot of people who get lucky in that they find a business that they want to invest in, they wait a little while, it gets 30% cheaper, they invest in it, and it goes up a ton. But that is not replicable if you do not have a strategy that is telling you exactly when you should be buying, when you should be waiting, and when you should be selling that stock. So that's what we're going to go through in today's video. Now, before we get into exploring the appropriate price to pay for a stock and why it is that most of the time businesses have really expensive stock prices that are too high for us to want to invest in, it's important that we have, of course, analyzed the business fundamentally first, that we have decided and reached a conclusion that says that this business is actually great. So there's a ton of videos on my channel. I'll leave a bunch of them linked down in the description below to check out so that you can sort of expand your knowledge on how to analyze the business and figure out if it's a great business. But basically, we're talking about looking for things such as making sure we understand how the business functions, making sure it's within our circle of competence, as Warren Buffett would say, making sure the business has a distinct competitive advantage, something unique, looking at management in a number of different ways. There's a couple of videos I have on my channel going through management. And once we have those things, basically what that tells us is we're looking for businesses that are very predictable in the future, right? So businesses that have a high chance that customers will be coming back in high numbers over the next few decades. That's why we try and look for businesses with a distinct advantage so that we are confident that customers will be coming back. We're looking for businesses with a low chance of failing during a short-term negative event. So that's why we look at debt management, for example. We're also looking for a management team that is very skillful at reinvesting capital within the business. And we can use something like the return on invested capital to assess that, making sure that management is consistently generating 10% or more yearly returns on their investments. And of course, coming full circle again, back to circle of competence, you need to understand the business so that you can project the future cash flows of the business. Because ultimately, to figure out what price to pay for a business, we need to estimate what the future cash flows of that business will be. If you can't estimate the future cash flows, you can't figure out what price to pay. And that's okay. If you can't estimate the future cash flows of a business, you can try analyze a different business. If you can't do it for any businesses, then you can just buy the index and consistently invest in the market, participate in the market, and generate market average returns. That's the alternative option for you. But today, of course, we are going to be talking about analyzing the cash flows of a business that you understand. And I'm going to continue to use this corporate travel management business as an example, as I did in the previous video. Now, the first thing that I want to say is that a lot of the time you'll hear people talking about a stock is overvalued, right? It's overvalued here or it's undervalued here. But I think that's a little bit misleading. I think it makes people a little bit confused about what we're talking about. So I think a better way to think about a stock's price is what return will I make, right? So instead of thinking, okay, the stock might be overvalued here, thinking what is the return I would make if I purchase the stock here? And at the same time, if the stock's down here at $5, what is the return that I would likely make if I bought the stock here? So that's the way you should think about it. And when I say overvalued, what I really mean is the return over the long term when purchasing the stock at that price is low, right? So if you buy the stock here, the return is going to be either negative or just unsatisfactory, right? 4% or 5%. And when I say that a stock is undervalued, what I'm really saying is that it's offering a substantial long-term return, that it's offering a return that I am satisfied with. And for those who've been following the channel for a while, you would know that the return I'm satisfied with is a 15% yearly return. Okay, so I'm targeting a 15% return. But when you're using my spreadsheet, which by the way, I haven't mentioned this yet, but the spreadsheet is free. You can go and download it and use it to analyze any businesses you want to. So link as well down in the description below. But when you're using my spreadsheet, even though I'm targeting 15%, I'm not going to be putting 15% in here, right? And you'll often hear me talk about 22%, 23%. And the reason why is we need a margin of safety for errors, right? So basically how this spreadsheet works is we enter in the cash flow for owners or the free cash flow figure from the previous year, right? We put it there. Then we estimate some growth rates that cash flow figure will grow at over the next 10 years. And each of these years is showing us the subsequent year or the year after in terms of the growth of cash flow. So if we're looking at corporate travel management, for example, the 2019 cash flow for owners was $120 million. And then if we're estimating 10% growth, that means it'll be 131 in 2020, 145, 159, 175, and so on and so forth. And then the other most important thing here is to enter in a required rate of return. So this is the return we're targeting. And I target 23% because I need to allow for errors, right? I could be wrong in these growth rates. They might grow at 8% per year. And if they grow at 8% per year, I still want to be buying the stock so that I will make a 15% return. And that means that I target a higher return. Now, if you enter in, let's go with 15%, for example, using these models, you can see that the buy price for the 10% model is about $13 per share. If I then change my required rate of return to 23%, you will see that the buy price goes down to about $7.50, right? So it's a little bit, it's about 40% less than the previous price. So that's how I'm including my margin of safety. Now, an alternative method would be to enter 15% as the required rate of return and then just divide the buy price by 50% or by 40% for whatever margin of safety you wanted, right? So that's an alternative approach. I typically like to keep it to one step. So I use a 23 or a 22% required rate of return. And that gives me a substantial margin of safety. Now, what I want to show you here is that a lot of people can identify that a business is great. And when they do so, they buy the stock. And that means that most of the time, really great businesses have really high stock prices. And what that means when the stock price is high is, as we mentioned, the long-term return is low. When the stock price is high, we're not going to be able to buy it and be confident that we're going to make a 15% return. We're not going to be able to buy it when we're targeting a 23% return. So I want to show you an example of how that changed for corporate travel management over time. So you can see that the stock back in 2018 was as high as about $30 per share. It ranged from about $20 to $30 throughout that year. And if we go back and look at what the discounted cash flow would have looked like in 2018, they had cash flow for owners of $87 million, use the same models, and let's say we're trying to target that 23% return. You can see that the buy range is between $5 and $7 per share, which is far lower than this $30 price, right? So that means that the stock price is nowhere near a buy around that time. In fact, we can change the required rate of return to see what return we would likely make if we had purchased the stock back in 2018. And the likely long-term return, as you can see, is about 6%, right? So what am I doing here? When I change my desired return to 6%, you can see that the buy price is equal to what the stock price was back in 2018. So that basically means that the expected return, assuming they grow at between 10 and 15% per year over the next 10 years, is about 6%, which is very, very underwhelming. Then we can fast forward to 2020, right? And you can see that obviously the stock price came down substantially. And during that period, the business continued to grow. So their cash flow for owners in 2019 was $120 million. So quite a substantial increase from the $87 million in 2018, I believe that was. So now, again, we can do our discounted cash flow. And again, we're targeting 23%. and we have a buy range. And the buy range is between $8 and about $10 per share. Except this time, the stock wasn't massively overvalued. In fact, the stock actually got down to, well, it got down to about $4.50, I believe. So it got down to $4.50, which is even below these models, right? If we're assuming 10% growth, then we're getting a pretty substantial return if we're buying it at $4.50, which was the case when I was investing in the company. That you can see that the return would be well over 35% per year is the expected return when buying the stock at $4.50. So I think the most important thing here is that it's possible that at some time, maybe it's this year, maybe it's next year, maybe it was last year for you, but at some point you're going to be analyzing a great business and it is going to look like corporate travel management in 2018, right? Your buy range, as we saw, is going to be $5 to $7 and the stock's price is going to be 30. And you're going to think, how on earth am I ever going to invest in this company? And this is obviously quite a dramatic example because we did have a pandemic that directly stopped the travel industry in many ways. So this is a dramatic example, but there will be times where your buy price is $20 per share and the stock's price is 50 or the stock's price is 40. And you're thinking to yourself, when on earth is this stock's price going to drop 50% or drop 60%? And what you need to do is you need to decide whether you're willing to accept a low return, like you could have bought corporate travel back at $30 per share and you would be negative right now, and maybe over the long term, you'll make about a 6% return if they grow at 10 to 15%. Or you can just stick it on your watch list, look for other businesses, and build a watch list, as I said in that previous video, of 10 to 20 to 30 businesses, maybe not 30, maybe 10 to 20 businesses that you deeply understand. And every now and then, one or two of them will get cheap enough. One or two of them will go through this, right? Corporate travel went through this. Thought Industries went through this. They're not on the ASX. Thought Industries went through this. Facebook went through this. Texas Roadhouse went through this. Those are the 4 businesses that I've invested substantially into. I'm not buying more of them now, so don't think that you can just go out and copy those investments. They're not at prices where I'm satisfied to invest in them anymore. But it doesn't happen very often, but when it does, I invest heavily, and that is how I've been able to build a substantial return on my portfolio in a small number of businesses that I deeply understand. So I hope you guys got some value out of this video. I know it's a little bit different than the typical video, and to be honest, the reason why I'm doing videos with screen recording is because my Mac didn't turn on last week or a couple of days ago, so it's getting repaired at the moment, and I'm working with a laptop that has far less editing power, so I'm just going to be doing some basic videos this week, but I hope you still get some value out of these, sort of demonstrating some stuff in the spreadsheet. And as I mentioned, there's a ton of videos going through all of these concepts that I kind of briefly went over in this video. All of those videos are linked down in the description below, and also you can get access to the link to download the spreadsheet. It's completely free, so you can access that as well. But let me know if you have any questions down in the comment section. I'll be answering questions as always as this video goes live. But other than that, hope you guys have a great day, and I'll see you in the next video.